Good afternoon, everybody. Buenos dias. It's a pleasure to be with you in Mexico City today, where we're going to be discussing a great deal of excitement taking place in financial markets. I'm sure you're all aware about some of the recent moves and even swings this morning. I've got the great pleasure of moderating this panel with a wonderful group of contributors, and we thank all of you for your contribution. But with that in mind, there's so much to talk about and to digest. I'm just going to go straight on with our panelists. So it's my honor to introduce Andres, Bernardo, Prakash, and David. And with that in mind, I'm going to start with Andres. And my question is that we are already into the second quarter of 2025. Some would say that 2024 feels like a lifetime ago. If you would have seen the swings in the market overnight and this morning, maybe even this week, which is a lifetime ago. Of course, I'm talking about the trade tariffs and the world market uncertainty that we're all seeing taking place. And my question to each of you is, what is your reaction to the trade tariffs that are taking place, and also the recent moves in financial markets across different regions, jurisdictions, and different asset classes, with some seeing the steepest losses since the pandemic. But of course, this morning, we've also seen significant swings in the other direction. So with that in mind, Andres, I will please start with you. What is your reaction to the recent market moves?
Hi. I mean, it's very difficult, to be honest. This changes every minute. The swings that we have seen on the past days are just unbelievable. No, those swings. Today, the Nasdaq, I think, is already 10% up. And if I update my phone, maybe it's 12% in 2 minutes. We had swings this week of plus 4% and then minus 4%. The VIX index just crazy moves. So that is what the crazy uncertainty that Trump has put into the market is doing. It's for me, it's very difficult to give a forecast, but it seems that what Trump is doing. First of all, I see two different scenarios at the moment. One in which Trump de-escalate, which is what he just did this morning. And essentially, that de-escalation will bring lower economic growth, but maybe if the de-escalation won't bring a global recession, no? And probably it's an easier path to Powell, no? If he doesn't de-escalate, which he already did this morning, I was seeing a global recession and a loss of trust out of America, and to be honest, a global financial crisis. At the moment, what we're seeing is maybe a guy that is negotiating, that it's not that stupid, sorry for the word, and essentially, this maybe is a war against China, no? But China has a powerful tool, which is selling treasuries, which they have been doing overnight and will probably do again tonight. And they will devaluate the yuan. At the moment, because this changes very fast, I think this is a war on China. And Trump will have to call Powell and say, I'm in a war with China, let's start QE and let's buy those treasuries that China is selling, and let's win this war. But it's very difficult for me to say what is going to happen. Essentially, it seems this morning that he de-escalated. The economic growth in America will be lower, of course, but not a recession, maybe. And I mean, in terms of inflation, I mean, the tariffs are not, maybe we're going to have some inflation, but if the tariffs are not in, that recession is not going to be fully priced in. I will stop here to let the other colleagues speak.
Thank you so much for your contribution. I think that the key theme we picked up there is uncertainty, and everything is subject to change. We're going to talk about central bank policy, dollarization, and so many topics later in this panel. But with that in mind, Mr. Bernardo, what is your view on some of the recent swings we've seen across financial markets, economic sentiment, asset classes? What are you watching?
Well, yes. First, I want to mention, and this is obvious for most people in Mexico, but we are one of the first commercial allies of the United States. that market is very important for Mexico,
course.
even more important to Mexico than to the US.
Of course.
But it seems that Trump and the US government has been soft, in a way to say, with Mexico rather than the rest of the world. And specifically some industries, as automotive industry, will be suffering a lot based on these tariffs. And this swing, as we already mentioned, and Andres contributed, it's of 8%. This 8% is a huge swing,
Of course.
that represents a lot of opportunity. And as a big four firm, where we are advising clients with their strategy, their growth, IPOs, the market is worried. And some companies are starting to put a break in their growth and expansion strategy as a cautious, or as a caution of what can happen. But the most important part here is that, when is it going to end? That's the biggest question. When will Trump end with this blackmail around tariffs? And will he stop soon? Or will maybe we will be living with this for the next 4 years? Nobody knows.
That's the thing. I think even if you look at the White House administration or some of the comments that are coming out, I don't think even they know how this is going to unfold. Mr. Prakash, what is your view on some of the recent swings we've seen across different asset classes?
Hi. So shock to begin with. We had a 3-day move, the sell-off we haven't seen in 37 years
Yes.
in the S&P. So there's a lot of shock, not only at the scale of the tariffs, but also at the kind of the economics, which is which the tariffs are based on, right? So there's a misalignment between the policy and economic reality.
The whiteboard.
Exactly. So, the idea that tariffs can reduce the trade deficit, which is the original idea, of course, is flawed, right? So in 2018, when the administration introduced tariffs, the following year, the trade deficit widened by 12%. So of course, there's a lot of other things at play here. You have national savings, investment demand, and of course, the role of the US dollar as well. And with this round of tariffs, it's interesting that the study that the tariffs was based on, a University of Chicago economist, he actually said that the study was misapplied. And he couldn't believe that they were trying to implement tariffs at this scale. And in fact, he said that they should be, if anything, a quarter of that amount. So I think there's definitely a lot of posturing. We're currently in a policy-based volatility regime. There's no doubt about it. Even the rally today, who knows, it could reverse by tomorrow. However, if you take a step back and you think of, you think about what he's trying to achieve, and then you think about the history of, all the posturing, then definitely I think there's a lot of opportunities, because the initial moves are very similar to 2018, the start of COVID. Basically, all risk assets fell, right? So you had gold falling, you had stocks falling, you had Bitcoin falling, everything. And that tells me that the initial reaction was a huge liquidity correction. So what we may see now over the next couple of months is we may start seeing rebalancing of global flows. We may start seeing winners and losers in terms of countries, in terms of industries, in terms of sectors. And this will definitely create a lot of opportunities.
Thank you, Prakash. I'm listening to that answer there, and I keep thinking about that metaphor of this administration playing poker and seeing who's going to blink first. With that in mind, David, what is your view, please, on what's happened in recent financial market changes of sentiment, asset classes? What's caught your eye?
So I think from my point of view, I would say I don't think this ever had anything to do with tariffs. The tariff conversation is merely there to distract and implement an overall strategy. I mean, as you quite rightly said, the justification and the calculation were absurd. Everybody knew it when they said it. Everybody knew it afterwards. What we've seen is the American administration go through a process where they believe that they have the power to be able to coerce the majority of their trade partners into ganging up on China. That's all this is. So they can have 75 countries come to them to ask to negotiate. It's irrelevant. It's about the EU and it's about China. And the EU being the EU, I mean, I'm European and they're the most dysfunctional group of people you're ever going to meet, right? So
Agreed.
but I think the real target here is China, and it's the only thing that the entire product is about. So I think what you need to do is you need to take a step back and look at what he's really trying to do. So this morning he gave everybody except China 90 days, and he reduced the overall tariff for everybody but China that he put up. So what he's really trying to do is he's trying to bully and align the rest of the nations so that they have a pivot of an axis that can go against China. And we can all wax lyrical about the market moves and what was going on. It was never about that. They don't care about that. This is about the US administration having control and power over China. I mean, there's lots of downsides to that. I think the biggest problem potentially for Trump is that he overplays his hand and he thinks he has more power than he does. But the overall effect of what we've seen in the last few days really is a repricing of overpriced assets. That's it.
And that brings us amazingly well to our next topic, because as some of our panelists have just suggested, that some asset classes have moved by swings we haven't seen in decades, others we haven't seen swings since the pandemic and so forth. But a contrarian would suggest that maybe some of the swings lower have been because of how inflated different asset classes have been for a long time. For example, gold prices have hit new all-time highs more times than one can count. US financial markets were at record highs and all-time highs more times than one will remember. So my next question for each of you is whether we were just taking profits or whether this uncertainty that's taken place suggests there might be something steeper in the background. Of course, Andres has already mentioned the risks of a global recession that is becoming more of a topical interest. But essentially, that's my question to each of you. Are the swings because of overinflated price assets, or should we be more concerned about what's happening in the world? And I will start with you, please, Andres.
Okay. The problem here is when you look at the volatility, look at the VIX and the movements on the VIX. And when there's so much volatility in the markets, everybody looks and reprice the assets, no? We have seen, for example, semiconductors, no, like stocks like Nvidia, Broadcom, on crazy highest levels. I think semiconductors were very expensive. That's repricing. We think other assets were cheaper, and they are gonna go higher maybe. But essentially, what this crisis does, like the COVID or the global financial crisis or the .com, they put all the assets where they should be. I think, no, or it's what the market tries to do. Yes, I understand that after COVID, no, everything blew up, no, or in a good manner. That was essentially what the Fed did with all these policies that they had, and look where inflation got in 2022 and 2023, 8% in the US. I never saw that in my lifetime, maybe. And yeah, this is a repricing of assets because of the volatility. But I agree a lot with what David mentioned. This is against China. He hates China. He's going with China. And essentially, I think that what he sees China is a very big country that he cannot control further, and or that the US cannot control. And this is probably a way to say to China, I want to control you. Or if I cannot control you, you're not gonna be as bigger as you are. No. Essentially, again, David, I agree with you in everything that you say. With the European Union is very different. I think you have a very debilitated European Union at the moment. The only one is Germany, which the expenditure package that they approved early March, I think. But essentially, Europe is in a very bad position. I think the euro was repricing higher, which is very bad for Europe, and they have Russia, no? So essentially, the European Union is, hey, US, help me. I have Russia here. Aren't you gonna help me? So they are in a very bad position to negotiate. So again, this is against China, as I mentioned before, and we're gonna see a war against China. China has their tools; they can sell the treasuries, and China can devalue the yuan, and then the U.S. can buy the treasuries via QE. I don't know what is gonna happen, but essentially, what we're seeing is a trade war with China, not with the world. And he essentially is trying to convince the rest of the world that China are the bad guys. Is a little bit what I see.
Thank you, Andres. Bernardo, anything to add?
Yes, I think that context is really important here. And Mexican stock market, for example, is rather small. We have about 150 companies. So this volatility into the stock markets isn't affecting us as deep as a currency change could affect us, as inflation could affect us. And once again, stating that our first commercial ally in the world is the US, tariffs could impact deeply into the Mexican economy. But once again, it's a lot about context. And maybe these will also help us on the other side, because we're receiving a lot of pressure from the US on security and safety matters, on fighting against narcotics, for example. So this is going to impact a lot deeper. And I think that was also what your question was about the deeper impact that this will have, rather than the impact on the swings and going back and forth for traders. I think it's going to get a lot deeper than that, with specific policies, new regulations, and starting to work in a more even commercial world, going further than the tariffs.
It's like a lot of smoke and mirrors. Prakash, anything to add?
So yeah, just on 2024, of course, valuations were stretched, no doubt about it. And 2024 was pricing in like a near perfect narrative, 2025 was supposed to be the year of AI revolution. Pricing in like a soft landing. And I agree that there's definitely a repricing given the change in regime. There's that. And I do also agree that this is not the end. I think this, as I said, I think the first phase was the de-risking and all about liquidity. And then the next stage is going to be more about, rebalancing global flows. As Bernardo mentioned, unilateralism. I think we will continue to see this, the protectionist narrative going forward for the rest of the year as well.
There we go, guys. It seems like there's a long movie being played out here. Let's get our popcorn, or as we're in Mexico, maybe some nachos, enjoy some of the local cuisine. David, what do you think about this?
So I would probably take a step back and ask how we got here. So if you go back to the financial crisis in 2006, the global liquidity footprint has tripled in 2 decades. So we have an entire global industry and global framework that's based on a tremendous amount of liquidity that has been incredibly cheap to access. So the provider of most of that liquidity was the US, which is why US assets have far outstripped everybody else. And what we're really going to see, I think, going forward, and we've started to see now, is a repricing of those assets. It should have happened as interest rates went up, because the tech industry is a great example of somebody that can borrow money for nothing. Every 200 projects that they put together, probably 5 work. But if you're not paying money for that capital, it doesn't matter.
Exactly.
Now you're paying money for that capital, and you've disrupted the global regime that allowed that process to happen. So for me, this is the beginning of a repricing. I think the market volatility that you've seen over the last few days has been deleveraging leverage. I don't believe China has sold any of their long-dated treasuries. From what I understand from our side, it's basically been de-risking leverage trades. So the basis trade in the bond markets has all but been de-risked to a level where it needs to be. And we've seen a huge amount of leveraged money de-risk their portfolios. I don't think real money have done anything much yet, and they'll be happy today because it justifies not moving. I think retail is probably still very long at good levels, relatively so. But I think leverage money has been totally taken out. And that's really what we saw Sunday night. Margin calls, everybody had to hit the bid. You hit the bid in things that are liquid, which is why all the stock indices got hit. The movements in the bond market going forward, I think, are actually the tell. Rates shouldn't be going up. In this kind of risk scenario, rates should be going down. And I personally don't believe the Fed is there to put a put in at all. I don't think they would have been even if we carried on. And I think that by doing what Trump's done, he effectively disorientates what the people that were his allies. And they will have to reprice their relationship with him, and everything gets repriced with it.
Thank you so much. Gentlemen, we're already more than halfway through our panel session, so I'm going to jump through a couple of topics. But I think one thing that's going to be a topical of interest in Mexico, as much as it will be in other places of the world, is the sudden increases and the threats we're seeing of institutions threatening a global economic recession. Andres pointed this out in his first answer. So my question to each of you briefly is, do you see the possibility of a global economic recession increasing, given all of the uncertainties that's taken place? Or do we, as David's just pointed out, just need to take a step back and see how this unfolds? I'll start with you, Andres.
Okay, 9 a.m. today, I was seeing a global recession. At the moment, I am not. No, this is the uncertainty that we have. No,
Agreed.
With what just Trump said, the 90-day stop on all tariffs except the countries that retaliated, I think was what he did. If that stay and tariffs are not are gonna be for except for China, I think. If that scenario stays, I don't see a global recession. I see a global slowdown because of the uncertainty. U.S. was expected to grow this year at the beginning, I think 2.2%. Now it's 1.7%, I think, the latest on the Fed. We'll have the next Fed growth scenario, but probably it will be 1.2, 1.4. So there is a global, at the moment, with what Trump just said 2 hours ago, I don't see a global economic recession. I see a global economic slowdown. So we are putting our pedal from the we're accelerating less. But yeah, essentially, I see a slowdown. No, we'll see how the tariffs develop. It's very difficult to say so. The thing that is different is that in 2008 there was a global economic crisis because of problems with credit. Essentially, that was a credit crisis. 2020 was a COVID. There was a COVID. Essentially, we knew what happened. This is provoked by the U.S. government, and essentially, normally the governments in the crisis try to help. This right now, the government is provoking the crisis. So, no crisis, but a slowdown.
So this disruption is essentially going to lead to maybe more risk of an economic slowdown.
And just to interrupt, in Mexico, I do see a technical recession.
Okay, thank you so much. Bernardo, anything to add?
Yeah, it's interesting because it seems like the institutions start crying wolf, and then everyone starts to get worried, and companies stop investing and want to stop growing and want to take care of their costs and their expenses and do cut downs. And we start looking around for the wolf, and we cannot see the actual wolf walking around us, but everyone starts crying wolf. So what I'm trying to say here is that there's also some things that are happening that are interesting as the interest rates dropping. And that could also make the companies start growing again with better and bigger investments. So I think we should be cautious, and that the only thing that will be certain for the rest of the year will be uncertainty.
I agree with you. These headlines are quite scary, and I do think we're living in a more of a clickbait world where headlines get clicked on. Prakash, what is your view?
So, of course, tariffs normally have quite a nuanced impact, right? You hear the term stagflation going around, and that's essentially inflation and slowing growth. So my opinion would be that we have to see whether the de-risking, the revaluations, etc., is just contained to the stock market. If it starts overspilling to the real economy and starts affecting, labor and consumer spending and retail spending, and all of these other variables, then we may start seeing a bigger spillover. So it really depends now what people's expectations are, whether they should, wait to buy that, the car that they wanted to purchase, whether they should just take a hold of their spending patterns, do a readjustment. And this, we won't know maybe for a while, how this volatility has affected spending patterns. We, of course, know that there's a lot of anecdotes, right? We saw a lot of companies front-loading inventories the last couple of months. And essentially, they're protecting themselves for the next few months. And then you hear all of the anecdotal stories about small businesses which have now, frozen stock orders. There's cases where they're saying they can't afford to pay the tariffs. And so if this, of course, then starts affecting labor, etc., then we might start seeing a bit more of a panic.
Thank you, Prakash. David, anything to add?
Well, again, I guess I kind of have a slightly different view of it, in the sense that I don't think you can have a view. I think if you look at what's happened in the last 7 days, how can you have a view? I mean, I think all the panelists said that there's huge uncertainty. Different scenarios give different end results. It's probably not what everybody wants to hear, but I don't think I have a view. I don't know what's going to happen. I think the key thing to take away from it is that you need to be flexible, and you need to be able to react to what comes along, as we saw this morning. I think having a view at this stage of the cycle, political, economic, geopolitical, I think is too difficult. I don't have one. I'm not clever enough.
You're not the only one. I also put my hand up. I don't have a view, really, and everything's taking place as swig and all sorts. I'm going to switch it up a little bit, and I'm going to stick with you, David. Look, we've talked about so many asset classes having steep falls, industries that might be impacted. But are there any opportunities or assets that might actually benefit from everything that's taken place? We can talk about industries now, economies. Do you see any opportunities given what's taken place?
Yeah, I mean, it's pretty clear from the last week that if there's one thing there's going to be a lot of this year, is volatility. Mm-hmm. So if you like to trade markets, if you like to be involved in directional views and predictions, you're going to have a year of your life. This is going to be the year to understand that you have opportunity. But last night is a great example, and this morning is a great example, that investors need to understand that they need to adjust what they're doing. So they need to adjust the size of their positions, adjust their leverage, adjust the confidence they have in jumping into positions as they would have done before. So for me, I think the only bit of advice that I would offer, if it's fair to offer it, would be cautious, be careful, and always have enough held back that you can take advantage of something that you never saw coming. And that's exactly what we've had for the last 7 days, right? So I think you just need to be careful. You need to scale back, and you need to be cautious, more cautious than you have been.
Thank you, David. Prakash?
Yeah, I completely agree with David's comment about being cautious. Opportunities, yeah, again, agree. There'll be plenty for those who wanted to, get in on certain stocks, for those who want to get in on other assets in oil, in gold, there's enough volatility to get in. And I agree completely about the position sizing. If you then look at, for example, if this unilateral protectionist kind of regime is going to go forward, then of course, companies which have pricing power, companies who have more power over their profit margins, companies who don't have just as a high import dependency, companies who can adapt quickly. Those are the names that I would be personally targeting. Yeah.
Thank you, Prakash. Bernardo?
Yes, I totally agree with this being cautious part, but I also think that the markets and companies must be brave, resilient. And we already went through a pandemic. We went through a lot of disruption, and this is something new on top of that. And the world will probably continue to be like this. And in a couple of years further, we will have more climate change, and there's a lot of things going on. So I also think that companies should be brave. Just hearing the institutions called recession shouldn't stop us or shouldn't make us slower. And I think if the companies and the markets continue to also place their bets, we can also help the economy grow a little bit more.
Thank you, Bernardo. So there's still maybe some opportunities. Andres, anything to add to this one?
I mean, again, the biggest winners will be brokers, no? With volatility. No, but I mean, to be honest, it's very difficult to call an industry or a sector on such a changing environment, no? I would say play it safe, play it defensive, play it a half or a quarter of you try to play, because these movements are huge. You could be liquidated fast. And I honestly don't have an industry or a sector to trade. Maybe if this is a war with China, they will be winners. Mexico could be a big winner if the way the president Claudio Sheinbaum has played it, like we are gonna be friends of the USA. If it's really a war on China and they want a partner, they could have Mexico increase their production capacity, and we could get some of that capacity that China will have. But I think it will be an opportunity to Mexico if they play it well.
Thank you so much. Gentlemen, we've got just over 5 minutes left, and I want to try and please get through 2 more questions. And I think that we also need to remember that the purpose of this panel is to provide investor education, the right content during very uncertain times. And I thank all of you for your contributions towards what is a period of uncertainty. But my question to each of you is, speaking about educational tools, what resources and education tools would you suggest that our audience can use and can keep on track on in order to keep up to date with what is a very volatile and subject to change world? But what would you look for in terms of sources? And I'm going to start with you, David, if you please don't mind.
No, it's fine. I think from my point of view, you need to engage with people that you trust. So whether that's your broker, whether it's the way that you source your news, whether it's the people that you talk to and you listen to, you must do your homework. You must know the people that you're talking to, and you must trust what they're telling you. There's so many people out there that are purely there for you to make money for them, not for you. So my best tip of education is talk to intelligent people that you know understand what they're talking about. You know you can trust them. Always, always be careful about who you're trading with. Regulation is there for a reason. It's there to protect people. And I would say generally brokers and institutions that are regulated in good jurisdictions have a good purpose in life, and they're there to help you, not necessarily just to take your money from you.
Thank you, David. Very wise advice. Prakash, anything that you would like to add?
Yeah. So I think with moves like this, it's good to think about frameworks. So developing a framework that works for you. And this doesn't necessarily mean, just going to one source, but trying to understand the moves, trying to understand relative moves, the correlations, all of these things, and really kind of see when these correlations start switching. So, I mean, in terms of news education, I mean, I wouldn't say like a specific source. I like David's idea about speaking to somebody that you know who's gone through it. But definitely, there's a lot of good news sources which are objective. Yeah.
I think social media tools like Twitter are definitely going to be popular once again. Bernardo, anything that you're going to be suggesting for a specific source or a tool that maybe our audience can use to keep on track of what is something very subject to change?
Yeah, I see a lot of people now using artificial intelligence, especially generative artificial intelligence around trading. And you know, you can have such a deep analysis and so many big data mining and analysis, using artificial intelligence. So my bet would be first to learn how to use artificial intelligence, because it's not just plugging my computer and start asking questions, but also understand what I'm trying to analyze. So my biggest bet would be around that. Generative artificial intelligence at the moment.
That's a good point. I think that this world is run by wacky people right now. So maybe we just trust robots or something to help us. Andres, what would you suggest?
I mean, I think your question is more exactly if you are going to trade tomorrow and you're starting, what tools you can use, no? If
Yeah.
you're a retail investor, no?
Yes, can be.
Okay, I to be honest, if I were to trade tomorrow or educate my children, no, in the market, is start early, open a brokerage account, start trading small. That's the best way to learn. When you have a position, you follow the trend. If you don't have a position, you don't follow anything. But in specific tools, I like soccer a lot. I like Cristiano Ronaldo a lot, and you start following the people that you like. No, if you like soccer, you follow Cristiano, you follow Messi, you follow Zidane. No, and sorry for that. If you like trading, start following traders in Twitter. That's a good tool. Keep reading, keep looking into news. Bloomberg TV is a very good source. To be honest, it's free in most smart TVs. Of course, there is a strong research from big banks, but that not as easy as accessible. So if you're starting, go to Twitter, start following the people that you like, start following traders, Bloomberg TV, and I will say if you're new on this, the trend is your friend, and the wisdom of the crowds a bit.
Thank you so much. And guys, we've got just over 1 minute left. I think briefly, of course, this is a very uncertain landscape. There's a lot that's changing maybe by the minute, if not by the hour. Are there any themes or potential risks that you suggest that we keep watching as this movie unfolds that we would like to leave our audiences to think about as our concluding words? And I will go to you, Andres.
I mean, as I said before, no, trade with half of your positions or 1/4 of you used to trade, play it safe, and be very defensive, very defensive.
Thank you. Bernardo?
Yes, I think we have to, specifically in Mexico, for example, and Latin America, harvest some of the new regulation changes that will boost the growth of capital markets. And if we want to talk about trading, let's talk about the size of the markets. And we are not maybe there yet.
Okay. Prakash?
I would say, resilience over prediction. Try not to just guess what you think's going to happen. Yeah.
Yeah, I would agree with that. I mean, for me, do things that you know or you're comfortable and you're confident with. Just because everybody else is shouting about the shiny thing in the corner doesn't mean to say you have to trade it, right? So be in your comfort zone and do what makes you comfortable and makes you confident.
Thank you, gentlemen. Guys, thank you so much for your patience today, and thank you for listening to this panel. I also want to thank all of our panelists for their contributions during what is a very wild and uncertain and eventful period of market uncertainty. Thank you for having us in Mexico City. Hope you enjoy the rest of your event. And once again, thank you to all of you for your contributions.
Thank you.